How long have you been dreaming of making $1,000 a month without slaving away at 3 jobs? Maybe $1,000 isn't enough for you, and you're gunning for $10,000 or even more. Well, the principle behind passive income stays the same regardless, so let's cut to the chase. Today I'll show you how to set up a money flow that practically hits your bank account on autopilot. Yes, it's more intense than it sounds. You'll have to invest time, money, and nerves, but the payoff is worth it. Ready? Still hesitating? Stick around, you won't be able to look away. Let's get one thing straight from the start. Passive income isn't some magic button where money falls out of the sky. If you aim for a higher amount, fantastic, but you'll need to learn, work smart, and invest your resources. Once this machine is up and running, you can truly take a break while the cash keeps rolling in without your constant oversight. If you'd rather sit in denial hoping someone else will do all the work for you, feel free to click away now. The rest of you, listen up. Here, you'll find real strategies to reach $1,000 a month, $10,000, or any figure you set your sights on. The main point is this: stop dreaming and start doing. Now decide, will you stand still or move forward? Let's begin. Instrument number 1, the stock market. Let's begin with a classic: stocks. By buying a company's shares, you become a partial owner. If the company grows, so does your share price. Many companies also distribute dividends quarterly or annually. Typical annual returns, on average 7 to 10% for broad market indices, though it can be higher or lower. Monthly equivalent, approximately 0.5 to 0.8%. Risk: in times of crisis, stocks can drop sharply. Think back to 2008 or 2020. Over the long term, however, major indices like the S&P 500 usually recover and move upward. This is a solid option for anyone seeking a relatively straightforward way to grow capital. Real estate investment trusts let you earn rental income without owning property directly. The fund manages offices, hotels, warehouses, etc., and the rental profits are distributed among shareholders. Possible returns: typically 3 to 8% annually, though some higher risk REITs can reach 10 to 12%. Monthly equivalent: about 0.3 to 1%. Some REITs pay dividends monthly, others quarterly. Pros: you don't need to find tenants or deal with maintenance and paperwork. Cons: REIT share prices can fluctuate with the real estate market, which can slump during recessions. Still, if you're interested in real estate but don't have a large sum to buy property, REITs are a solid starting point. Instrument number 3, bonds. Bonds are more conservative than stocks. Essentially, you loan money to a government entity or company, and they repay you with interest. Returns: typically 2 to 12% annually, about 0.2 to 1% per month. Key feature: the interest rate is usually locked in if you hold the bond until maturity. You won't see the same volatility as with stocks. So many people use bonds to stabilize their portfolios. This is perfect for anyone who prefers to preserve capital more reliably, trading off the chance of higher gains. All these instruments, stocks, REITs, and bonds, can be purchased through a brokerage. Look into fees, reputation, and which markets you can access. Some prefer international brokers, others go for local ones. The main point is to understand each broker's terms and confirm they're trustworthy. How much to invest for $1,000 a month? Let's say your goal is $1,000 a month, which is $12,000 a year. If we assume an average annual return of 10%, you'd need about $120,000 in capital. That sounds like a lot, but remember, you don't have to deposit it all at once. Many people build up their portfolio gradually by contributing every month and eventually hit the target. Keep in mind, 10% is just an average figure. In reality, the market can return more or less depending on which assets you choose. Instrument number 4, cryptocurrency. The crypto market is highly volatile yet offers big potential. Major companies and hedge funds hold some of their assets in Bitcoin. However, crypto also carries higher risks than traditional stocks. There are many ways to earn through crypto, such as staking stablecoins, spot trading, using trading bots, etc. Be aware that crypto prices can swing by double-digit percentages in a single day. Crypto staking. Staking stablecoins is one of the simplest routes. You lock up USDT, USDC, or other stablecoins on an exchange and earn interest. Returns: typically 4 to 12% annually, around 0.3 to 1% per month. In peak periods, offers might hit 20% a year. Pros: Stablecoins track the dollar, so their volatility is lower than Bitcoin or Ether. Cons: you're still exposed to platform risk. If the exchange or platform has issues, your funds could be in jeopardy. Always do due diligence. Spot trading crypto is closer to active trading than passive investing. You buy coins and wait for them to appreciate. Typical returns 10 to 30% annually, 1 to 2% monthly. With a conservative approach, though skilled traders sometimes see 50 to 200%. Risk: high volatility, news-driven price changes. Novices often struggle if they pick random coins without research. For a less risky approach, try the DCA, dollar cost averaging strategy, investing fixed amounts at regular intervals. Trading bots are software that execute trades based on parameters you set. Conservative bot might earn 2 to 5% per month if settings are geared towards safety and you keep a sufficient reserve. Aggressive bot, potentially 10 to 20% per month, but also a far greater risk of liquidation if the market swings sharply. Remember proper risk management. Always maintain a buffer to avoid getting wiped out. With responsible settings, a trading bot can become a reliable source of passive income. Let's look at a few more tools. Peer-to-peer lending. Interest around 1 to 2% per month, 12 to 24% annually. Risk: borrowers might default, so you need platforms that thoroughly check creditworthiness. ETFs. Returns roughly 5 to 15% annually, 0.4 to 1.2% per month. Key benefit: you buy a basket of assets, indices, specific market sectors, or bonds. Robo-advisors. Returns 5 to 10% annually, 0.4 to 0.8% monthly, depending on whether you choose a conservative, balanced, or aggressive strategy. Benefit: automated portfolio rebalancing based on your risk profile. Each approach has its pros and cons. Only you can decide what fits your goals and risk tolerance. The importance of diversification. There's no single magic instrument that always rises and always pays out. Markets move in cycles and different assets react in different ways during crises and booms. That's why experienced investors preach diversification. Some money in stocks, some in bonds, some in crypto, and some in more conservative options. This reduces the chance of massive losses if one sector plummets. Gradual progress and consistency. Reaching a passive income of $1,000 quickly isn't easy. More often it comes from steady, disciplined contributions. Make it a habit to save a part of your earnings, reinvest profits, and learn from small mistakes. Over time, you'll see what brings you the best returns in your situation. Conclusion and next steps. Today we covered stocks, real estate investment trusts, swing bonds, crypto, staking, bots, spot trading, P2P lending, ETFs, and robo-advisors. Each one comes with its own potential returns and its own level of risk. Most importantly, mix several approaches so you're not dependent on one single factor. Thanks for watching, and see you in the next video.
They say I couldn't do it and they feel. They say I wouldn't do it and I fall. They say I couldn't do it and I did.